David, it is great to be here with you today. Thanks for joining me. For regular Fool readers and viewers, you need absolutely no introduction, but I'm going to introduce you anyway. You're one of the co-founders of the Motley Fool. You lead the Rule Breaker service, which has crushed the S&P 500. You are part of the Stock Advisor service, one half of the Stock Advisor scorecard, also crushing the S&P 500. And now you are working on, I'd like to think that it's like a passion project for you, not that all of this isn't, but the Supernova service. Tell the viewers a little bit about what the service is and what you're offering to subscribers with that.
Sure. Well, first of all, let me just say thanks, Matt, and I'm really looking forward to our conversation today. I'm excited about it. Yes. So briefly, Supernova is, if you think of Stock Advisor and the stock that I have in Stock Advisor and Rule Breakers, and a separate set of stocks and Rule Breakers, if you bring them all together and create a whole service that invests in portfolios, that's what Supernova does. And Supernova has a fun space-oriented name, so we call our missions, our portfolios missions. So it's almost like NASA. So you take my stock picks and you NASA them up and turn them not just from individual beads, but you start stringing necklaces. And that's really what Motley Fool Supernova does. It's going to reopen again in January of 2014. It's an exciting service.
So thinking about Rule Breakers, thinking about Stock Advisor, now thinking about Supernova Odyssey, one of the things that I want to do here is get behind all of that to some of your thinking. And one of the places I want to start, because I've always thought of myself largely as a value investor.
Okay.
And I've heard you say time and time again that one of the things you look for in the stocks you invest in is that the financial media at some point has said that they're overvalued. And when I first heard you say that, I thought you were crazy. But then over the years, listening to you say it over and over again, I think I've gotten it down to, it's not that you're telling people to buy stocks or buy companies that are priced at more than they're worth. You're just saying that these companies are worth way more than anybody realizes that they're actually worth. Have I gotten that right yet?
I think that's a pretty good way of thinking about it. Yes, one of the things I specifically look for are stocks that look too expensive to buy. They're trading, maybe they don't have enough earnings yet, or maybe there's such a premium brand or there's so much excitement about them that they have a crazy high PE ratio. This is not specifically how I screen or look at things.
Sure.
I don't even screen stocks at all, Matt, but I always have been a fan of stocks that look overvalued. And as it turns out, those are many of my best picks over the last 20 years. 10 baggers, 20 baggers plus sometimes. These are the companies that looked so overvalued when we first found them.
So a company like Tesla, for example, that I think a lot of people are looking at right now and saying, whoa, the valuation on that is crazy when they look at the PE multiple. The eventual, the value of that company and what it can create is potentially worth so much more than that.
Yeah, I think here's what happens. First of all, the stock market always looks ahead, and this frustrates a lot of people who are looking backwards and looking at their financial statements and their multiples, and they're like, but it's already trading at 35 times last year's earnings, which is what PE ratios usually do. They look backward. The stock market always looks forward, as you know. So when you have exciting futures, which is what I invest in, then the future looks much better than the past just looked. So that's part of the reason overvalued works. By the way, there's a whole dynamic to this, and that's the first key component, is that my companies typically are very innovative, so they have very bright futures, and so you end up, they look overvalued. Further, and then let's go to the next question. I don't want to go too deep on this, but further, a lot of them are premium brands and premium pricing. And it's kind of like when you buy a diamond at Tiffany, you're going to pay more than Diamonds R Us. Sure. And it's because when you shop at Tiffany, they have higher quality. And so you're going to pay a higher multiple or more than you thought you would pay for a diamond, or more than you thought you would pay for food at Whole Foods, or more than you thought you should pay for coffee at Starbucks. And the list goes on. So when you take those exciting futures I started with, the stocks already look overvalued. And then when you think about the premium pricing and premium brands, then it makes them look even more overvalued than that. And I mean, that's most of it. There's one final dynamic that I'll give only lip service to, but when it's very disruptive, when a company has the chance, as Tesla does, to remake the infrastructure of how cars are done in the United States, that allows an extra dynamic of speculation, which in the best of times causes stocks to become 10 baggers, and in the worst of times can cause the stock to be cut in half in a day or two.
Sure.
Sometimes. So those are three really key factors. And in the end, they're only going to be possessed by truly special companies. Some of them will fail. But those are the great companies, and those are the ones we buy and hold.
Great. So this year, the Nobel Committee awarded a Nobel Prize in Economics to Robert Shiller. And Robert Shiller, of course, he's done a lot of work in behavioral economics and swimming against the tide of efficient markets, which essentially say stocks are priced as they should be, and there's no opportunity for individual investors like us to make any extra money by investing in individual stocks. In founding the Motley Fool, you and Tom, and then all of us fools that followed have obviously not followed the efficient markets hypothesis. Shiller has sort of proved that out now. What gave you the confidence that that you'd be able to invest in individual stocks and make money doing that, even when the efficient markets folks were saying, you can't do that, it's not possible, just invest in an index fund?
Well, I truly believe, by the way, that the concept that you can't be better than average applied to any discipline is silly, but especially when you think that that would have been put forward by academia with regard to investing. I think it's the kind of theory that can only exist outside of, well, maybe in academia, frankly. I don't want to quip too much here, but I think it's really a crazy notion that you can't be better than average at investing, but anything else that you pursue, there can be experts and there can be novices. So Matt, my simplest answer is that I watched my dad, as I grew up, beat the stock market on a regular basis, not by being an active person, but by finding great companies and sticking with them. I watched my uncle, who's a professional money manager, has been outstanding over the years. I watched people like Warren Buffett. I read Peter Lynch's book at a very early stage. So I was taught the stock market as a kid. So I naturally just assumed that if you apply yourself, that you can be superior. And then I happened to meet up with people like you and a whole bunch of our Motley Fool employees and community and people who have taught me, and we all teach each other about the stocks and businesses we're looking at. It gives us such an edge over the computers that we're competing against that are automating their trading and looking microsecond to microsecond, or the academics who say, oh no, it's not even worth trying because you can't do better than average, which I've always believed is silly. So that's how I think about it.
Well, I gotta jump off on the computer comment that you made there. There has been a lot of concern about the supercomputers that are trading, the high-speed trading, all of that kind of stuff. There are investors and people in the media who are now saying that because of these computers, again, there's no more opportunity for individual investors because you're going against the computers and you're never going to beat a computer. Is that it? Is our business over?
Yeah, I mean, well, I have to laugh because, of course, I think that computers, as much as I admire them, as much as I admire automation in general, and a lot of that high-frequency trading is actually not the evil bugaboo that it's often made out to be. It's really created much thinner spreads, and we as investors, there's a lot less friction when we trade or when we buy and sell, lower prices all the way through, partly thanks to automated trading. But the supercomputer, the Watson, hasn't yet been invented that really, I think, will always beat the stock market or put people who use their own judgment out of business. I'm very open to the possibility, and if so, I'd like to be invested in the company and the computer that does that in time. But Matt, there's such a myopia. There's so much near-term focus, and most of the computers and the automated trading you're talking about are really dialed not into the day or hour or minute, but down to the microsecond. That's where a lot of it's happening. And that's a completely different game, of course, from long-term investing, which I think we're proving continues to show that it's the best way to create and grow wealth. So when I start to see computers that are really thinking in 5-year increments, then I personally and professionally will start to become worried for my own job. But right now I see computers dialing in more narrowly and more narrowly, programmed by humans, and that's how they think, and that's their game, and they're welcome to play it. It really doesn't even impact what you and I are doing, teaching investing and buying to hold as investors ourselves, great companies.
Sure. And on the opposite end of the spectrum from that, and you just mentioned Warren Buffett as somebody that you watched as proof that the markets aren't efficient and that you can buy, one can buy individual stocks and outperform. I saw an interview you did with Brian Richards earlier this year, and another of our fellow fools, and you had mentioned that you admire Warren Buffett and you take some things from his approach, but then you leave some behind. Now, I was curious to hear, what's an example of one thing that you still use that you learned from Buffett? And maybe what's one thing that you've said, I'll let Buffett have that and I'll go a different direction?
Okay, well, I mean, there's too many answers to both of those, but to give one succinct one to each, I would say, first of all, from Buffett, I think we've all learned that investing is rational and long-term. And when you put those two things together, you will emerge with superior returns. And I think he's demonstrated that over the course of his life. And I think for the Motley Fool now entering its third decade of picking stocks online, I think our historical record demonstrates that. How do I not do the Buffett thing? I mean, most of what I do isn't the Buffett thing. I'll just answer that Warren, and in many cases those for whom he is an exemplar, have sort of opted out of technology, or really even wanting to think about or use or invest in technology. And that's highly ironic to me, because I think we live in the most exciting technological age of all time. And the opportunities to invest in companies early on like Amazon.com, or more recently in things like cloud computing and 3D printing, I could not possibly sit here and say, I'm eschewing that, can't really predict where that's headed. So, you know, our chief investment officer, Andy Cross here at The Fool, said, Dave, here's one thing I realized is the exact opposite for you with Warren. Warren likes to find a company that has one definite future. It's like See's Candies or Geico. It's going to be around 30 years from now. They're going to be doing the same thing, and he loves that, and his disciples do. And I certainly admire that. Andy does too. He said, Dave, you love the companies that have 30 possible futures. You love optionality. You love finding something that can all of a sudden morph into a whole different thing, like Amazon.com books. All of a sudden, they're selling everything online. All of a sudden, they're actually doing cloud hosting and web services, and they've developed their own device, the Kindle, and it goes. And those are the companies that I love, where you're finding companies that can morph and grow in ways that people didn't expect or couldn't foresee, and me included. So I guess I love the companies with infinite possible futures, and there are a lot of people who are just looking for the one sure future.
Sure, that makes sense. And thinking about those companies with a lot of different futures, a lot of different opportunity. You mentioned 3D printing, you mentioned cloud computing, which to some extent it seems like the sky is not the limit, but it seems like it at some point, because there's so much opportunity. When you are thinking about investments, how big of a role does market opportunity play? Is that like number one on your list?
I think that's really big for me. And when you say market opportunity, I mean, maybe all of our viewers know what you mean, but I'll just redefine it as how big could that business become? And I think that is, I've used the phrase in the past, venture capital mentality. I think that's what I have, and I think that those who enjoy Rule Breakers or Stock Advisor, our Supernova members, a lot of us are practicing that more venture capital approach, where it's not about the PE ratio, it's about looking management in the eye. It's not about how the stock did over the last year. It's actually where the next 5 years of that technology is going to be. So you're so business focused relative to an investor world that I think is still largely too stock focused. People are looking at wiggles and waggles and 52-week highs, but I think those who are taking our approach are really thinking about the market opportunity and asking ourselves, how big could that technology be? E-commerce. Mm-hmm. And then that company, eBay, let's say, within e-commerce, how large could that grow over time? And always looking ahead.
And talk about optionality at a company like eBay, what you're just talking about. I mean, the size of the PayPal business within that, and who would have thought about that when it was just an online exchange?
That's right. Well, the reason eBay is in the Supernova universe, that it's on my side of the scorecard in Stock Advisor, is because it bought my pick, PayPal, out. Because I love finding often the companies like Marvel that Disney, or Pixar, that Disney later comes along and buys, and we usually just keep holding right through. So I still own my Disney, right, but it's my Pixar and my Marvel and Disney, and I still own my eBay, but it was PayPal becoming eBay. So one of the tricks you can learn over time, and by the way, it's never intentional on my part. I'm always as surprised as anybody when one of my companies gets lapped up. But one of the tricks is how you figured out how to buy Disney at a dramatic discount to Disney's price. And the answer was to buy a company that Disney's buying out that gets a 50% premium. That was the way to buy the biggest companies of our time at much cheaper discounts.
That's something that Buffett could probably learn from you, getting in on those value type.
Let me say that I can't say I'm a student of it at all. I viewed it more as luck, so I claim no omniscience or ability there. I will say, though, that Bob Iger at Disney clearly shares some thought with me because he keeps buying all my favorite companies. And I even did a video a few years ago, probably available somewhere on our website, saying, hey, Bob, I got your next one, because you just bought out Pixar, which has been one of my favorite picks, and then you bought out Marvel, one of my best performers ever. Go ahead and look at Discovery next, because I think Discovery, as a media company and a company of the imagination, would fit really well with Disney.
Now, quickly, is it more of a happy day or a sad day for you when somebody buys out one of your companies?
I think it's exciting. I mean, I'm the first to say I think we would have made more on Marvel had Marvel stayed independent. At the same time, Disney's added things to Marvel that Marvel would have had to work really hard to get to, like all of a sudden having theme park rides for its characters, or that great distribution, or probably more Marvel movies this year than Marvel would have had on its own. So. And it's always exciting to see a premium and a stock all of a sudden be up 30% or 80% sometimes in a single morning because the big company's coming along to lap it up. So the fan and human in me thinks it's fun. In the end, if you don't want to stick with that bigger company, sell a stock, move on.
So I'm gonna jump from there into some of your past investments, and some of these are still some current investments. And
okay.
Marvel is a great jumping off point, since they they're doing a deal with Netflix to come out with some series a few years from now. And I'm gonna refer to my notes here because I want to get this right. Netflix has been one of your biggest winners as a pick. And I went back to 2003 and was reading Reed Hastings' letter to shareholders. And some of what he wrote
10 years ago.
10 years ago.
Okay.
This just sounds prophetic to me. So he projected $1 billion in revenue, 2006-2007 timeframe. Netflix finished 2007 with $1.2 billion in revenue. So almost head on.
Wow.
He said that very large companies would try to compete with Netflix and fail. So Amazon's Prime still trying to do that. We'll see how that plays out. But Blockbuster didn't quite get there. Walmart didn't quite get there. And then finally, this is in 2003, he said they were starting downloadable movies. He said 2005 will be early for downloading, and we expect only modest consumer interest initially. But we predict this market will grow steadily over the next 10 years. And oh my gosh, look at Netflix now with its streaming service. So what do you think separated Reed Hastings and these kind of statements that hit it head on from a lot of the other starry-eyed CEOs that saw big things and never quite got there?
That's a great question, and I will give a firm, quick answer.
Okay.
But I don't pretend that it fully describes the answers that great question deserves. My quickest, firmest answer to that is that he is a technologist. He's a techie. He thinks in terms of the technology and the growth, and he was in a media business. And I don't really like most of the media companies. Most of them are really big, and I think their CEOs are typically overpaid, and there's a whole bunch of ego out there, and the whole starry-eyed celeb thing, I'm not as into that. I'm more the Silicon Valley fan, and I'm the person who thinks the people who think about the future of technology are going to ace out the media fat cats almost every single time. So I think that Reed Hastings is the smartest guy in the room for his industry. I think you're a pretty smart guy that you went back and read what he was saying 10 years ago. In this fast-paced media world, very few people spend much time looking at the past, but what great lessons. And what I enjoyed about that, Matt, was that he used the phrase, and you read it, downloadable movies. No one uses that anymore.
Right, yeah.
But back in 2003, I guess that's what he was writing, the annual report, right? Because streaming, that whole concept, I guess, wasn't out there. Maybe it was in his head, but the language has even changed. It wasn't too long ago. But it's just been a great stock, a great company. They've made mistakes. Every great CEO, every innovative enterprise will. They'll make more mistakes in future, but it's been an outstanding investment. It's one of the most widely held stocks among our whole Motley Fool membership. So a whole bunch of prosperity has been created by that person and that company for a lot of us who are watching this video today.
That's great. And Another one, this is another big success for you here, and actually just passed a milestone. So Amazon.com,
Okay,
since
sure.
your first recommendation of Amazon, is now a 100-bagger.
It's actually more than that. Maybe we celebrated that last month. When I last checked, I think Amazon was up another $40, like $360. So I guess now it's a 120-bagger. But I mean, that's not a round number, so it's no fun to talk about. And I'm not meaning to brag at all. I mean, I never expected that kind of return. Although the only way you get that kind of return is by fighting through a whole bunch of tough times. The last 15 years have had two of the most breathtaking market drops of all time. And we just kept holding all the way through. And so anyway, a lot goes into a 120-bagger.
Yeah, it's the long-term holding really paid off there.
Yeah.
But one of the things that's always amazed me with Amazon is that Jeff Bezos has been so great about pushing back against Wall Street's need for the quarterly profits, the meter beat estimates, that whole deal. He's pushed back against that. He's been staunch about wanting to invest in this business to make it the best business it can possibly be, as opposed to report some profits right now just to make Wall Street happy.
Yep, I agree with that.
How has Jeff Bezos been able to do that? And what can every other CEO out there that's kowtowing to Wall Street learn from him?
I just think that that's how he thinks. And he, as the founder of a company, he just practiced what he preached all the way through. And I think he continues to do it. I was just in a meeting earlier today at Fool HQ hearing something new. I mean, I can't keep up with all that Amazon's doing at this point. And it's only one of 160 stocks or so that are in the supernova universe. So there's so much to keep up with. But just hearing that, now they're offering kind of streaming data cloud services. So for streaming data, so you think about the future of, some people call it the Internet of Things, other people call it machine to machine. Most of the data in the future, I think, isn't going to be you and me tapping data into our phones, or it's actually just going to be all the machines around us passively collecting information, and all of that has some value in it. And so Amazon just most recently is now offering the opportunity for partners to sign up and benefit from the cloud-based streaming data. So basically, Bezos is constantly thinking about what's next, and he's constantly setting himself and his business up to be prepared for that. He never just thought in terms of books, and he never just thought in terms of e-commerce. He continues to think about where the world's headed. And the world's headed in amazing places. I already can't believe the technology I enjoy today. I mean, even just like my silly Jawbone Up. I mean, this little thing, I mean, it counts all my steps. It counts my hours of sleep. It's fun. It gives me stats. I've got graphs and pie charts of my sleeping. I mean, that's silly crazy. And I actually do get more sleep as a consequence of caring about that and paying attention to it. So, you just think of that as one silly example. But there's so much to that. And the people who are thinking about that and orienting their businesses to help shape that and add value to your life and mine as consumers of these products and services, these are the people who are creating real wealth out there, and we're trying to get invested in them as early as possible in my services.
And hang on and hang on.
Yeah, and sometimes hang on too long. I mean, I never claim to be great at selling stocks. A lot of time I just don't sell, because one of the best ways, if you're not good at something, is take it out of the equation altogether. So, I mean, it's not that we never sell. We do issue sell orders from time to time, but for the most part, what I've done as an investor and what we do in Stock Advisor, Rule Breakers, and Supernova is, to a fault if necessary, we tend not to sell. And we are fairly over-dramatically rewarded for our laziness and inertia as a consequence of doing that.
Okay, now I did some reading back to you from Reed Hastings.
Yeah,
just before.
That was great. Downloadable movies.
Now I'm going to read back to you a little bit of some David Gardner around the same time.
All right, good.
So you recommended Marvel back when the first Spider-Man movie was coming out, and this is when Marvel was a $170 million company. And you said this company has been cranking out toys and comic books for some time before the Spider-Man movie and doing a pretty good business. But this whole realization that Marvel's characters are valuable to more than just 12-year-old boys could and should have occurred back in 1989 when DC Comics inked a deal for the first Batman movie. So you recognized here what was a huge inflection point for this company. This was an old company that dates back to, I think, the 1960s, right? And all of a sudden, they started marketing their characters in a whole different way. The company exploded. It ended up getting bought out by Disney, and look at where it is now. How do you find inflection points like that, and when do you know whether it's an inflection point like Marvel's, or whether it's a faker, for lack of a better way to put it?
Yeah, we call those faker breakers over rule breakers. Well, first of all, Matt, I will say, yeah, that Marvel investment has ended up being Disney now, and we've held the position all the way through. I think it's up more than 30 times in value. So, but there's two things I want to say that. The first is we were a little late in this sense. I recommended the stock after that first Spider-Man movie made a big splash. I think it came out maybe in May. Maybe March, April, May of that year, 2003-ish, I think. And it wasn't until August or September, after I'd already seen the movie and after the movie had a huge box office, that for whatever reason, Marvel stock fell from about 9, where it had risen from, by the way, almost nothing, down to maybe 5.5 or 6. It lost about a third of its value in the face of that outstanding performance. And so, I'll just say it's not like I sat ahead in time of the Spider-Man movie and said, watch what happens if they start making movies. I didn't. I was reacting to what had already happened. Sure. So that's one thing I want to point out. The second thing I'd like to point out is that the reason that Marvel became such a great investment was partly because there was so much skepticism that superhero movies were a fad. And that is probably one of my favorite tropes as an investor. I love it when people think something is a fad. I remember a decade earlier than that, at least, when Starbucks came public. The big rap on Starbucks was coffee houses. Coffee, $4 is such a fad. And now look at that hot IPO, and this is a fad. And it wasn't a fad, obviously. They truly reshaped the world around them. And there have been any number of these kinds of investments, and sometimes they are fads, by the way. So, I'm not going to claim 100% batting average on this, but I love it when people think, oh, that Spider-Man movie, man, they're not going to go to number 2, or once they have number 2, try it with another superhero, And these days, I just went to Thor: The Dark World last weekend. I thought it was a great movie, by the way. And Thor, one of my favorite characters probably growing up, really as not even being considered for movies back in 2003, right? There's been so much more content. I think maybe I said I only had 2 things. I'll give you a third thing here, which is
a bonus.
I love it when companies can morph. We talked about this a little bit earlier, but translate what they're doing into new opportunities people didn't see. So the real leverage there was comic stories, comic book, dying medium for the most part. But wow, this could actually translate to the silver screen. And think about how much money people make in Hollywood box office versus those poor guys who have their comic book stores. The heart and soul guys have been selling them. And I love some of the stores. By the way, I go to the stores from time to time myself. I usually buy board games when I'm there because they also sell 20-sided dice kind of games. But anyway, there was so much more money to be made off that content than the comic book medium. And so that was the big aha that I think we had. And I can't say it all happened at once. We just kind of persisted and then started to realize what was happening. Side note, let's stay geeky here. I mean, Lord of the Rings. I've always been a huge Lord of the Rings fan. Sure. Those were also just books. And then all of a sudden someone thought, this is actually a property. This is not just a trilogy. Let's take it out to movies. And then a bunch of other things too. Lunchboxes, games, all the rest. But I mean, it's realizing that initial indication of how you could make money, it could get much wider. It happens in biotech. We won't go there right now. But sometimes they'll approve a biotech drug in one situation, but then realize it has additional indications. And those are some of the best biotech stocks as well. So it's that optionality, that morphing, that let's call it the caterpillar could become a butterfly. And if you see that ahead of time, even if you're late, like the caterpillar's already in the cocoon,
right? You
weren't buying it when it was a caterpillar, you still do pretty well. In fact, you can even let it become a butterfly if you stick with the butterfly, and you'll still do awfully well as an investor, I think.
Well, it was a 20-bagger or 40-bagger. I think that's like 3 or 4 butterflies coming out of that.
Well, those are awesome. And, I want to mention one other stock that just because it's probably one of my favorite moments in Motley Fool Stock Advisor history was Priceline, which has probably been my best stock in Stock Advisor. And Priceline, we got early, it went up 8 times in value, and then I re-recommended it just a few years ago after an 8-bagger. And a lot of people are saying, Dave, really? I mean, this one's already up 8 times the value. William Shatner, Priceline, after it's up 700%, you're going to recommend it again? And I know you know where I'm headed because it's up more than 5 times the value since then. And so I think too many people think they've missed it too often.
So that would go back to Marvel as well with the Spider-Man movie, is that it was after that. So you're not necessarily too late just because something has already happened.
You know, the problem is, and we won't go into the whole psychoanalysis, and of course there's the anchoring biases and all that talk that is its own thing. But too often we as people think, looking backward, we're experts at now seeing what's happened. And if something happened well and we didn't do it, we kick ourselves. Mm-hmm. And at that point, we conclude, it's over. I blew it. And I see that all the time in investing. And I do it myself too, so I know why we do that. And that we do it. One of the best things you can do is get rid of that instinct and realize it's not about what already happened. It's totally, for every stock, any winner we've talked about or loser in our talk today, that's all irrelevant now. It's actually what happens next. Right? And that's where excellence usually stays excellent. And so you're usually rewarded, even now, for buying Amazon. If you've never bought Amazon, for owning some Amazon starting today, going, you didn't miss it. You know, you haven't missed it at any point in the last 15 years with that stock and many of our other great companies.
Great. Well, we've talked about some 20-baggers, some 40-baggers, a 100-bagger. Every once in a while, there's a miss in there, and Krispy Kreme,
more than every once in a while. Yeah, sure.
I'll say
there's a lot of them.
So looking back at Krispy Kreme, when I looked back at your original recommendation of Krispy Kreme, what was going on at the time? This was a growing company, and certainly it was an addictive product. I still have a Krispy Kreme donut every once in a while myself.
Sure.
And yet the company didn't perform as expected. Certainly the stock didn't perform as expected. What were the lessons that you took? I mean, everything looked so right. What were the lessons that you took away from how south that situation turned?
Well, I mean, check my math. In fact, you're good at reading back, and so since I'm spontaneously answering that, I'm not able to really. My memory's not great, but my recollection of Krispy Kreme is that it was very badly mismanaged. The CEO at the time. The big debate was how exciting is it to have a new Krispy Kreme open up in a new part of a neighborhood or a city, and the company was really great at hyping that up. There were people waiting around the block, and they were able to say, hey, look, we just opened our new one, and it's, people were waiting in line at midnight last night for Krispy Kreme, and the company began to buy back from its franchisees its stores, and it had a natural bias toward overpaying. If Matt and Dave started our Krispy Kreme, if it was buying back from us, would overpay us because it wanted to make it look like it's so valuable to have.
Sounds like a good deal to us.
Exactly. So we did well, but the problem is the company, and then trying to please Wall Street, near-term projections began to, I don't remember if it was fraudulent or not officially, but there were some cookbooks in there, some overstatement of the value of a Krispy Kreme at the unit level, and that just crushed the stock. So, one of my little tricks in my small bag of tricks, one of my tricks is trying not to learn too many lessons from my failures. I realize it's a great human thing. I always say, hey, you failed. Well, that's the way you learn your lessons. Well, actually, I think I would encourage a lot of us to look more at our successes and ask, what lessons should I be learning from that? And not even from our own, but from the world at large, like successful businesses, successful people. I try to learn as much from those. I prefer those kinds of lessons to looking at my failures. So I tend not to dwell that much on my failures. Good news is I can forget them awfully quickly. I think I lead a happier life. I realize I'm probably oblivious to all kinds of mistakes that I'm making. But so I didn't learn a tremendous amount from Krispy Kreme. I guess 2 quick final reflections on Krispy Kreme. Number 1, it isn't a very healthy product. I mean, I also enjoy a Krispy Kreme donut, although not as many as I once did. And I prefer to find companies whose products or services, I really do think if they massively proliferated, our world would be a much better place. I can't say that about Krispy Kreme. I'm not big-time health nut or anything, so I'm not going to make it sound like you're doing something wrong if you're buying from them. But I will say that point number 1 on Krispy Kreme, redux, looking back, I do prefer companies where if you can see everybody owning and using that product or service, it's a better world. And then the second thing about Krispy Kreme is that it was kind of a cookbook story. And it happened to me with Satyam Computer, another 90% plus loser on my side of the scorecard in Stock Advisor. And I just think we can't all be forensic accountants. We're going to get swindled from time to time. If you own 25, 30, 50 stocks over 20 years or so, these stories are going to pop up here and there. I do think that the world is more and more transparent, and if you're investing in good people and good companies, you're much less likely to have this happen to you. But you can't, allow yourself, once bitten, to be too shy going forward when you have a bad outcome.
Sure. All right, now transitioning to some of the exciting stories of today.
Okay.
These are mostly from the Supernova portfolio, from the Odyssey portfolio in particular, which I took a fancy to.
Great.
The 3D printing industry, which you mentioned earlier, two recommendations there: 3D Systems, Stratasys. It's such an exciting industry to me, and I love thinking about all the different directions it can go. And yet, as it develops, I think of companies like Apple, like Google, like Facebook, that weren't necessarily the first out there. Apple with cell phones, Google with the search engines, Facebook with social media, and they just did it better than everybody else. What is about 3D Systems and Stratasys that you think will let them outpace anybody else that tries to rush in?
Well, let me say that I never believe that I'm definitely going to be right on any stock. Even in my favorite stocks, I'm always going to allow at least a 20% chance that I'm completely wrong. So please don't take my confidence in these two companies to be any kind of assertion on my part that these are automatic future winners. You're right. The world is full of companies that got out there first, but as is sometimes said, it's the pioneers who get the arrows in their backs, and sometimes those who come after them are the ones who actually start to settle. That said, in the case of Stratasys is a company that's been there, done that, been doing 3D printing for quite a while at the institutional level, business to business. And that's not easy to recreate for other companies to build those relationships or have that R&D history or have that culture. Stratasys has also made some great acquisitions, Objet, MakerBot. Basically, it has continued to build itself out into almost a full-featured 3D printing winner, I think. And certainly it has been, looking backwards, a pretty big winner last 5 years or so. 3D Systems has a different approach. They're a little bit more consumer-focused, a little bit less B2B. They're also much more about acquisitions. So 3D Systems has been just doing dozens of acquisitions. So in a way, they're kind of rolling themselves up into being a big player, still in an early stage of an important technology. So I think each of those separately are perfectly viable and interesting models to pursue. And the last thing I want to say about 3D printing, although we can keep talking about it if you like, is there are going to be a lot of winners. It's like just because Amazon came along and dominated didn't mean that nobody else did e-commerce profitably and well. There are many very fine companies, good stocks we've had that are e-commerce companies over the last 10 years or so. So a big technology like 3D printing, there's lots of winners. In fact, maybe Apple and Google and others will be in there winning a lot. But I don't think that it's going to put Stratasys and 3D Systems out of business.
Okay. So, well, with 3D printing, that's sort of a new expanding area. When I think of Tesla or when I think of Whole Foods, they're transforming traditional industries.
Yep.
3D printing is a good example of a 3D Systems going out into a new area. Facebook and social media, a whole new area. Do you have a preference between companies that are transforming an industry versus pioneering it?
That's a great question. I don't have a preference. I love them both. I really do. I actually think they're kind of the same because in many cases, the pioneers do transform. It's not that whoever's out there first doesn't keep going. I mean, Amazon really was the first big e-commerce company, and lo and behold, 15 years or so later, they're the big e-commerce company, right? So they were the pioneer, and they've transformed whole areas of our lives that don't even have anything to do with books online, which is how they started.
Me.
So, I mean, I love the innovators. And innovators very often are pioneers, but sometimes they come along second and maybe they're more effective at transforming. I like the word transform, your word. I love transformational. I think those businesses, if you invest in them, they can transform your life and your investment portfolio if you find them and stick with them. It's not even get there early or ahead of everybody else. Right. It's more about sticking with it. How many Motley Fool members do I read about? And, we all do this. Maybe you kick yourself. I do too from time to time. They bought a great company early on and then sold it after the money doubled. And 10 years later, it's up 40 more times in value.
I've been there.
And it's not hard to have done if you do think ahead. I never bought Yahoo, and Yahoo they had some tough times there last few years, but from when I first found it, it's up 400 times in value or some crazy number. It's more about sticking with things. That's really what most people don't have the patience or the stick-to-itiveness to do. And so it's not about finding the transformational early pioneer. That's one trick. Mm-hmm. The harder thing to do is to hold them. I don't find it hard at all because I'm lazy, but a lot of people find that very hard.
Speaking of sticking through tough situations, Tile Shop, which is a recommendation, there was a very critical, I'll say report. It was probably a blog post is maybe a better way to describe it.
Sure, yeah.
But critical blog post out about the company, and I think the stock was down something like 40% in a single day. How do you deal with a situation like that? I mean, that'll churn the stomach of even the hardiest investor, I would have to imagine. How do you evaluate something like that, and how do you get past to the next day and just keep on investing?
Well, I mean, I kind of you to ask. I think you know the answer, and I'm sure you've done it yourself, Matt. I mean, I think it's just look past a day or look at the business. I would encourage. Early on, we at the Motley Fool, and I'm talking about just me and Tom, we didn't even have employees, we saw pump and dump happening in the early days of the online medium. We saw on Prodigy, for anybody who remembers it, and some of the other early, pre-internet online services, how people were pumping up penny stocks and then presumably selling the shares they owned to the people that they were exciting to buy those shares, right? Totally short-term phenomenon, highly unethical, in many cases illegal, anti-capital F foolish, anti-foolish in every imaginable way. The same thing basically continues to happen today. It's just that for the most part, a lot of that penny stuff has moved on to the opposite, which is shorting companies or taking negative positions and then unleashing a barrage of very short-term hype. And I guess the stock market is not resilient enough or still is willing to believe these sources enough that this is a recurring pattern that anybody who's around the Fool, and I know I'm speaking to a lot of people who are in our services and have seen this happen to a bunch of our stocks. You and I just talked about 3D Systems. It got pounded for something for being acquisition-oriented a year ago. I mean, these kinds of companies, I guess, are targeted by people with very short-term. They probably have a ton of options, and they are selling. Actually, they're buying back their short positions from people who are selling right down for those brief, dramatic drops. 3 quick things any investor should think about. Number one, who is the source of the information? Mm-hmm. For most of the so-called short attacks, there's not even a person. There will be a name. It'll be on Seeking Alpha, a site that I think it's typically on Seeking Alpha, a site that I guess you can publish anonymously on. And there won't be any human beings that I can see or any real analysts or names that are willing to put their name right next to that work. So I would always encourage every investor, first of all, who's my source? Number 2, what's the record of my source? If I can even figure out who the person is or what the hedge fund or analyst or whoever it is, what is that person's long-term track record? I mean, we do it in everything else, right? I mean, I want to know, has my doctor been around for a while? Is the person who's teaching me how to ski, has he skied before? All kinds of things that we would normally do. But for some reason, I guess, the stock market, or maybe we have too many machines dialed into auto trade, is willing to just concede 30% drops in good companies in just seconds or minutes based on, let's go back over it. I didn't do number 3 yet, but number 1, who? What's the reputation? What's the name? Who's the human? And number 2, what's their record? And then number 3, keep watching. Number 3, it's not about the day. Let's look a month later, 3 months later. That should be your approach. Those 3 steps as an investor in these situations. And I submit that if there's a fail at any one of those points, probably you're seeing something that is very ephemeral and not even worth your time. I really appreciate, in the case of Tile Shop, what our analyst Dave Meyer did. He took the time to read through the screed of the, all of this negativity and actually analyze it. He fact-checked. A lot of it was just flat out inaccurate. Some of it was potentially accurate. It's just rumors. But at the end, I think Dave simply showed our community that if you really take the time to look through it, you'll find that there's not a lot of real there. And then even a month or 2 or 3 months later, Matt, those stocks have kind of snapped back. And some of our fund members are like, hey, I love these things because now I get to buy great companies at 30% discounts. If that's the way the stock market's going to work, I buy that.
Let me see how far I can get with a one-word question here. Twitter.
Twitter is a public company now, thanks to the IPO.
Sure
Very
is.
successful. I feel like I've already gone on too long in my previous answers, so I'll try to be quicker on this one. There's a lot. You and I could do a whole 30-minute video just on Twitter. Not that I have that much knowledge, but there's a lot to think about as an investor. I guess my 2 biggest takeaways are, number 1, it is a great company. It has a very real future. And congratulations to anybody who works at Twitter and all those that are helped by Twitter. Most of all, the people who use Twitter. There's millions of them. And obviously, it's a very attractive site framework. And what they've done is add real value to the world in ways that you and I, it's hard to even calculate or see that. The whole news industry and on-site reporting, I mean, it's just amazing. So that's number 1. Number 2, it could end up being one of our stock picks. I haven't looked really deeply at it. Facebook sold off quite a bit from its IPO, and we recommended it then. Not predicting anything like that for Twitter. Sometimes we buy right near an IPO. I did it with the Container Store recently for Motley Full Stock Advisor, so I don't shy away from IPO pricing. That said, I'm not as excited when companies already have valuations in the tens of billions of dollars. When we bought Amazon, or you talked about earlier in the interview, Netflix, was down at a much smaller market cap. You could see how that could go up 10 times in value. You could see how maybe a company that was only at $200 million of market cap, or even $1 billion, how that could become $10 billion. When a stock starts at 20 plus billion or 40 billion, I mean, it's still interesting to me because I think Twitter could easily double from here and beat the market handily over the next 5 to 10 years. Absolutely. Is it going to be a mega winner? No. I think a lot of people come new to investing. They hear Twitter. I mean, the news was full of the Twitter IPO, right? Even if you weren't watching financial news, it was all out there. Everyone's like, are you going to buy Twitter?
Couldn't miss
As
it.
if, yeah, I know, you couldn't miss it. And I think it's kind of fun that the stock market hits the headlines like that from time to time. But I think a lot of people who don't really know investing think that the whole thing is, could you buy it that first day and maybe sell it for a 40% gain later in the day, I guess. The answer is no, never, really. That 70% gain you're hearing is from the pre-IPO pricing to where it kind of first trades in most cases. So anything like Twitter, to close this long, shaggy second point, it's not about the first day. It's about, is it going to be a winner 10 years from now? And by the way, that's true of every stock, whether it's IPO or not, or at least that's how we think of it.
Okay, let me wrap up here with a selfish question. I started out the interview by saying I've got a little bit of a value investor bent to me. When I hear you talk about this, when I think about the big opportunities out there, changing and transforming industries, when I hear about the optionality that you talk about in these companies, and when I think about trying to get that word overvalued out of my vocabulary a little bit more, when you think about all that, what is a company that you could recommend to me to help me for some therapy? We'll call it some therapy, some stock therapy, to get away from overvalued and to think about optionality and big opportunities.
It's a great question, Matt. There's a bunch of companies that I could answer right now because there are so many interesting, innovative companies. Before I give my answer, I want to say, I know you said value investor, and I think you know this about me, but I never use the phrase value investor or growth. I don't like those because I just feel like they're self-limiting, and the truth is, I also don't like phrases like, and this is just a brief note that I almost never sound, Democrat and Republican. I think those are labels that try to mean too much, and they end up just being divisive, and they don't actually really help the world or the conversation, in my opinion. So I never say I'm a growth investor, or if you do see me saying that, please slap me because I didn't mean to, because that's not how I think about it. So you and I are both investors, and we're both looking to grow our money over time. We're looking to maybe mix some safer ones and some riskier ones, and invest most of all, I hope, in companies that in some ways express who we are through the companies that we're selecting, right? I don't think you should be picking things that you know nothing about because Dave said it or Matt said it, right? I think in a lot of ways your portfolio should look like your bookshelf. It should show a lot about you based on what you're spending time with. All that said, a good company that challenges a lot of preconceived notions is Zillow. Zillow, right? So that a lot of us have used Zillow probably as a consumer. You tap in and see how much is my house worth, or that neighborhood that we're looking, So using the internet to, I used to say disrupt bricks and mortar. In this case, there's no bricks and mortar, and I'm not even sure there's that much disruption. Using the internet to do real estate better. And I think what's attractive about Zillow is it's very early on still. The company is a $3 billion market cap. That, by the way, is maybe about $2 billion more than about a year ago. So it's been a tremendous stock already. But you and I know, and if you were watching earlier, you know that shouldn't cause you to shy away and think, I miss Zillow. The truth is, where's the world headed? Toward even more real estate trading, even more use of the internet. And where are you going to go? You're going to go to the dominant brand name or two within that space that has global possibilities. You're going to go to a company that has a visionary CEO, a great culture, and finally, you're going to be buying a stock that has a crazy PE, right? I would never have paid that much before. When we bought Zillow, it was overvalued. That's part of what we liked about it. It looks overvalued now. And so I think, that's a good example. There's a lot of others. But I'll just, I'm not even here to say that's the stock, or I hope nobody watches this video and says, Dave said buy Zillow. I'm giving an example of a company that exhibits how I think about investing, that challenges a lot of people's preconceived notions about what works in investing.
Well, consider it on my watch list.
Great.
Love it.
Excellent.
Well, David, thank you so much. This has been great. This has been very instructive. And once again, thank you so much for joining me.
Matt, it's my pleasure. Let's do it again.
Absolutely.